If you want to invest in real estate, but you don't know whether you should raise money from a fund or from a syndication, today I'm going to make that distinction super simple for you to help you kind of cut through the noise, give you some real examples, some pros and cons, and a way to help you guys work your way through that. By the end of this video, you'll know which model is better for you. My name is Marcin Drozd. I've raised multiple nine figures in private capital. My team and I have done over $2 billion in deals across multifamily, commercial, retail, industrial, operating businesses, everything but taking a company public. Chances are on the capitalization side of the business, had some involvement in that regard. So what I wanted to do is take a few minutes here today and actually walk you guys through the differences between a syndication and a fund, which are the two most common ways that most real estate investors raise capital. So let's start with syndication. So what is a syndication? So best way to give you that analogy is imagine you're looking to buy an apartment building or business or car wash or whatever it is, and you've got a bunch of friends or a bunch of investors that all get together and want to own a piece of that particular business, piece of real estate, whatever it is. That is literally a textbook definition of a syndicated deal. You have a deal, it's tied up, you have the operator, they have a very specific deal that they're trying to do, and they're just trying to find the investors to fill in the gap. So, key points here is that a syndication is for one very specific asset, which is either a business or a building or a piece of property. And there's a very specific business plan tied around that one opportunity. Now, once that business is completed, whereas the property is refinanced and sold or fixed and flipped or whatever it is, when that deal is done, that entire legal structure is wound down. So that is literally the definition of a syndication. Now, here's some of the pros and cons of a syndication. So I'll go through some of the pros initially first. Number one, it is a much more clear investment. So in other words, it's a lot easier to explain to people because you could say that, hey, this particular building or this particular business, here's what we're buying, here's what it costs, here's what we think it's worth. And technically, it's potentially a lower risk opportunity if you're doing a really, really, really good syndication. So that's really good. The third thing is that, and I already mentioned it, is that typically a syndication is a lot simpler to explain, especially for newer investors, real estate investors, especially because you're saying you're using the deal as sort of the edification, the crutch. It's the thing that makes everything else make sense. And for a lot of newer real estate investors that don't have maybe a track record or a team, they can point to the deal as being a really good opportunity. And then the last one for pros for syndications is that syndication is typically, if done well, is a shorter time commitment. So some syndications can be 2 years, some can be 5 years, some can be 7 to 10. But generally, syndications can be shorter timeframes because it's one particular asset, one business, one set of actions that have to happen within that model. Now, here are some of the cons. Number one, you need to take the time to raise the capital. So, in other words, from the moment that you sign on for a deal, you're on the clock. So from that moment to when you run into the lawyer's office to get your legal paperwork in order for the syndication, to when you meet with investors, to when you start pitching the opportunity, you are on the clock. So literally time is not your friend in a syndication because you have 30, 60, maybe 90 days to get everything figured out. And a lot of syndicators end up getting really stressed out because you end up running after the deal almost the entire time. The second con to syndication is it's really difficult to have good leverage with the seller when your pitch is, hey, here's the deposit. And they're going to say, well, where's the rest of the money? And you're going to say, well, we're going to go get it. Trust us. We've done this 5 times. And that may be true, but it's really hard to negotiate a killer deal when you also don't have the cash in the bank. So that is a con, in my opinion. Number three, syndications are limited growth because every single time you do a syndication, the entire process of the legal paperwork has to restart. So every time you do a deal, you have to restart the entire process. So it's almost like a start, stop, which is, in my opinion, cumbersome. Another negative of the syndication model is the investor has to love the deal itself. So in other words, you're using the deal as the reason why they should invest and all of this. And finally, one more potential con in a syndication is that you have no flexibility on your deal. It's one deal, one set of business terms. Here's what we're doing. Here's where it's going. and that can end up creating complexity there. So again, syndications make sense. I've done them. I don't love syndications from my perspective, but they work, and a lot of people obviously do them really well. So that's one there. The other model that we were talking about is a fund. What is a fund? Now, the easiest way to describe a fund, because the word fund doesn't really have like a legal definition of itself. There's just different types of legal structures that accommodate different things. But generally speaking, a fund is an opportunity where you say, for example, hey, we're going to go do these types of things. You and your friends put your money together in a pool, and then you, for example, as the fund manager, then go out and buy multiple properties or multiple businesses over a period of time. So that literally is a fund. Now, key points of a fund, obviously, investors are typically writing checks before they know exactly what deals you're buying or buying into. The investors are relying very heavily on the manager to make good decisions. And ultimately, another big indicator of a fund is that if done well, the investor ends up having diversity across multiple deals, across multiple assets, or whatever it is that you're doing in your fund. So again, there's pros, there's cons. I'll go through the pros first. So the first pro, and probably the biggest pro of having a fund from a fund manager standpoint, is that you have the money ready to deploy. So in other words, you have the money in the bank as you're negotiating deals. So literally, the last property I bought, we did it in a fund model where we raised the capital before we had the deal. And literally, when we were at the closing, we were negotiating the transaction. We just showed them the bank account, and that drastically tipped the scales in our favor, because one of the biggest issues, as you guys may know, is when you're a seller, you're always wanting to make sure that the buyer can close. So what better way to show the buyer you can close than to be able to say, well, here's the bank account, here's all the money, here's half the money, here's whatever it is. And what that does is it drastically changes kind of the negotiating tactics that you can use. That's one. Two, within a fund itself, more deals means more diversification. Now, again, I know Warren Buffett says diversification is for people who don't know what they're doing, but let me explain. You can still diversify within a specific asset class or specific business and own multiple businesses or multiple properties in a specific market. So if one deal isn't doing all that well, you've got the other ones to kind of carry the load. And ultimately, that is a big pro. The third pro is you can scale, because if you build your fund correctly, you have the ability to raise capital on an ongoing basis. So, again, nothing wrong with syndications from a legal perspective, but it's a start, stop, start, stop, start, stop. Whereas with a fund, you set up your fund, you plan to raise money until you raise a certain amount of capital over a certain period of time, and you can keep going and going and going. And that really does, from an operating perspective, it's one less thing to have to manage as you're building and scaling your business. And another major pro is you have a flexible strategy. So depending on what your investment thesis is in your strategy, you can be flexible with the size of assets you buy or the types of assets you buy. So again, with the money in the bank, you can make really aggressive offers across multiple different assets and things like this. So those are the pros, but again, there's always pros and there's always cons. So let me give you a few of the cons that come to mind right at the gate. Number one, it is much harder for people to raise capital for funds if they've never raised money before or if they don't have a track record. So again, if you're new to the business, this is why so many people start with syndications, is because you need to build a track record, you need to build a team, you need to build some infrastructure. You got to get people around you that can help you develop that credibility and that momentum. So starting with a fund from day one with no history in the business or no track record of operating in whatever asset class you're in is going to be really tough, because now you have two things working against you. One is you don't have the credibility, and two, you don't even have the deal tied up that you can point to. So again, this is why syndications make a ton of sense for a certain type of person, but eventually a fund can potentially make a ton of sense too. So that's the first con. The second one is funds are generally a longer commitment time frame. I don't see funds that are 12 months or 24 months. Unless they're debt funds, which is a different conversation. But for the most part, equity funds are typically 5, 7, maybe even 10 years. I've seen them longer. And the reason for it is because what a fund model typically looks like is you have a 6 month to 2 year period where you're just fundraising. And then you have from that year to 2 year period, you have another year or 2 years when you're just deploying capital. And then you have maybe another 2 to 5 year window of when you're working the asset and maximizing the value. So the time frame for a private equity fund is generally 7, 10 plus years. And again, if the returns are worthwhile, it's certainly worth looking at. The third con is they're generally more complex to manage. So think about multiple bank accounts, multiple financial statements, all rolling up into one. There's a lot more moving parts with a fund, but again, it allows you to move a lot faster once you understand what it looks like. And maybe the last con, this is a kind of a 50-50 con or pro, but generally funds have higher investment minimums where syndications might have a 25 to $50,000 minimum. Funds are generally 100, 150,000 minimum because you're typically appealing to a different type of investors. So again, syndications, funds, they both work. It's like having a debate which one is, which is a better car, Porsche or Ferrari. Well, it depends on who you ask. They both will get you there. Obviously, work with your lawyers and accountants to make sure that everything makes sense. But if you do a side by side comparison between the two, it would look something like this. So syndication, you're again just to review, it's one specific property that you're after, whereas a fund has multiple properties. With the property itself, with a syndication, you typically know the deal before you actually buy it. With a fund, you typically don't. As far as the investor ownership, investors on a syndication have a pro rata stake in a very particular asset, whereas in a fund, they have a stake across an entire portfolio over an asset and control. Well, ultimately, in a syndication, investors know exactly what they're buying. In a fund, investors rely on the fund manager to make good decisions. So, and then as far as the risk level, it really depends on who your team is, who your operator is, and who's involved in the deal. Because I've seen funds that should be incredibly low risk that become a very high risk. And I've seen syndications that should have been a flaming pile of garbage, but because of the team, they actually turned into really good opportunities. So again, it's not the structure that makes or breaks the deal. The structure is something that should complement the team, the opportunity, the deal, the things that you're working on. So that's a little bit about the model between a fund and a syndication. Now, look, if you guys want to figure out which one is a better fit for you, definitely join my community and Capital Connectors in school. Check it out. There's a ton of information there to help you figure out how to structure your deal, how to raise capital, how to package yourself, how to position yourself in the marketplace. And ultimately, those are the things that are going to make the bigger difference. Now, gun to my head, if someone asks me, well, Marcin, which one's a better fit for me? Well, if you're newer to bigger deals, I would say start with syndications. And if you're already an existing operator running a 7 or 8 or 9 figure portfolio business and you've already got systems and processes and a track record and you've effectively been running a fund with your own money and maybe a handful of people, then that transition to a fund over syndication would make a ton of sense. Personally, for us, me, my clients, my investors, we typically look at the fund model because it is much, much more flexible. Hope that's been helpful for you guys. Again, my name is Marcin Drozd. I've raised multiple 9 figures in private capital. If you want to learn how to do this for your business, whether it's an operating business, a real estate business, we've got all kinds of people within our community. It's a free community. I recommend you look at it. It's called Capital Connectors and it's in the school platform. So